Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cleveland CLIFFS Inc. quarterly report. Cleveland CLIFFS Inc. offers a diverse range of products and services across various industries. The company's business portfolio includes steel production, hot-rolled, cold-rolled, electro-galvanized, galvanized, aluminized, galvalume, enameling, and advanced high-strength steel stainless steel production. Austenitic, martensitic, duplex, precipitation hardening, and ferritic stainless steel products, steel plates electrical steel products, grain-oriented and non-oriented electrical steel tubular components, carbon steel, stainless steel, and electric resistance, welded tubing tin mill products, tooling and sampling solutions for hot and cold stamp assembly ingots, rolled blooms, and cast blooms, hot briquetted iron products, iron ore mining. 5 mines in Minnesota and Michigan. The company serves various industries including automotive, infrastructure, manufacturing, distributors, converters, and steel producers. The Cleveland CLIFFS Inc. stock price has made no significant changes in the past year due to a mix of positive and negative factors that have balanced each other out. The company's Q3 2025 earnings report showed a narrower-than-expected loss but missed revenue estimates, while its exploration of rare earth metals caused an initial surge in the stock price. Strategic partnerships and trade policies, such as Section 232 tariffs on steel from China, have also contributed to increased domestic demand. However, operational adjustments, including idling or partially idling mines and steel plants due to weak automotive production, have had a mixed effect on the stock. The company's cost management efforts, including reduced capital expenditures and SG&A expenses, have been seen as positive developments. Analysts hold consensus rating suggests a neutral outlook on the stock's future performance, reflecting the balance of both positive and negative factors. Overall, the Cleveland CLIFFS Inc. stock price has remained relatively stable due to the offsetting effects of these various factors, resulting in no significant changes over the past year. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by the increase in demand for domestically produced vehicles due to automotive tariffs, higher domestic HRC pricing, and lower import levels. Additionally, the addition of Stelco has contributed significantly to revenue growth, with incremental tons sold valued at $400 million. Improved end-user demand and decreasing interest rates have also positively impacted revenue. On the other hand, revenue decline is primarily attributed to inconsistent buying behavior from automotive, service centers, and other customers, resulting in lower tons sold. The decision to indefinitely idle certain operations due to financial underperformance has also contributed to revenue decline. Overall, the company's revenue growth or decline is largely influenced by market demand, pricing, and operational decisions. Net income and profit margins. A shift in the wrong direction. The financial summary reveals a concerning trend in net income and profit margins. In 2025, the company's net loss increased from -$232 million to -$234 million compared to 2024, indicating a slight decline. However, the 9-month period saw a significant jump in net loss from -$280 million to -$1.193 billion. Profit margins also took a hit. The operating loss margin worsened from -5.7% in 2024 to -4.3% in 2025 for the year, and plummeted to -8.7% compared to -2% in the same period last year. On the other hand, adjusted EBITDA margin showed a mixed performance, increasing in Q3 2025 but decreasing significantly over the YTD period. The reasons behind these changes are attributed to lower selling prices for steel products and the conclusion of an unprofitable contract, which shifted the business towards higher margin activities. These factors have contributed to the decline in net income and profit margins, indicating a challenging period for the company. The company's financial performance indicates a significant shortfall in its ability to generate positive operating cash flow. With an operating cash flow of -$449 million, the company is experiencing substantial outflows from its core operations. This negative trend suggests that the business may be struggling to cover its expenses and invest in growth initiatives, posing potential risks for long-term sustainability. The company's debt level has experienced mixed results. While the total debt increased by $503 million to $14,583 million, the redemption of senior notes led to a decrease of $685 million in debt level. Additionally, the net proceeds from senior notes increased by $1.124 billion. Regarding interest expenses, there is conflicting information between pages 3 and 46. However, it appears that interest expense has generally increased, with a notable increase of $207 million for the 9 months ended September 30, 2025. The financial summary reveals a mixed performance across various segments and regions. The steelmaking segment showed growth in the infrastructure and manufacturing market, plus 14%, automotive market, plus 2%, and other businesses segment, particularly in the automotive market, plus 17%, and infrastructure and manufacturing market, plus 22%. However, it experienced decline in distributors and converters market, minus 2%, and other markets, minus 3%. Additionally, cold-rolled steel product line performed poorly with a minus 5% drop. Management is optimistic about the company's outlook, citing several key drivers of growth. The company expects domestic steel demand to increase due to tariffs, which will benefit them for years to come. They also anticipate healthier vehicle production over the coming years, driven by increased demand for domestically produced vehicles that consume domestically made steel. The company plans to invest in facilities and equipment to maintain and upgrade assets, while shifting sales and product mix to higher margin business after 2025. This will enable them to generate healthy free cash flow, which they intend to use to deleverage the balance sheet. Management is focused on preserving liquidity levels, strengthening the balance sheet, and creating financial flexibility. They believe that their current liquidity and access to capital markets will be adequate for the next 12 months and foreseeable future. Overall, the company's strategy is centered around investing in growth opportunities while maintaining a strong financial position. While there are some specific instances of concern regarding inventory buildup and supply chain disruption, the overall assessment suggests that these issues are not significant. Inventory buildup is noted on page 33, but supply chain disruptions are limited to a few isolated incidents, including idled facilities and weak automotive production, as well as ongoing conflict between Russia and Ukraine. Despite these localized concerns, the broader picture indicates no substantial worries about inventory buildup or supply chain disruption. That concludes the financial summary for Cleveland CLIFFS Inc. Feel free to comment below, and I will be happy to answer them when possible.